is today's topic? Today's topic are three. It's a fairly busy topic. Most of you are in the process of raising equity capital. So what we do is we're going to start by looking at following up on our previous workshop is once you have your financial statements ready, what do we do with these financial statements? So if I am an investor, what do I look at your financial statements, and what will be the values that I take from the financial statement that we have covered during the last meeting? So this is quite important, and this is the whole topic of what I define as financial ratio analysis. What are these financial ratios? What are these ratios measuring? Financial ratios are quite important that we have. Once we have done this, you are in the process of raising capital, so how do you go about valuing your company? So what are the value and what are the different methodologies to value a certain company? Now we could apply the valuation to a company. I could take Roger. Roger here as an individual, I could sit down with Roger, and after asking him a number of questions, I could come up with a value. What is the value today, the financial value of Roger, and whether he's creating value or is he now depleting value over time. So what applies in methodology to a company actually could apply to each one of you. So if I look at Ziad, or if I look to, so each one of you has a certain value, and our role is basically to help you define what this value is. Part of the value is based on the assets that you have, the liabilities that you carry, but part of the values are also related to the future income that you'll be generating. So we'll go through the valuation. I'll explain to you a bit the different concept of valuation. And then at the end, what we'll do is that we'll look at, once you have a value, you've decided on what the investors you want to have, is how do we go about first selecting these investors, and how do we go about negotiating what we call a term sheet. So if in the case, I use again the case of, let's say in the case of Ziad, if Ziad has a potential investor, this investor is going to look at Ziad, agree on a valuation, and then the investor will come up with a certain set of terms and conditions that he wants as an investor to protect his interest, and Ziad would also look at what he needs to do from an owner perspective in order to find, this is what we call a term sheet. A term sheet is an agreement that we have between somebody who wants to put money in the company and somebody who wants to receive money from the company. So, and I will show you an example of a term sheet, and actually this is a real term sheet of a real company with whom we work, and this term sheet contains all the things that could be negative from an investor perspective in terms of investing. So I'll try to use it with very practical cases. Now this is what I have in mind over the next, now we have about 3.5 hours together. What I will do is I'll also use, so you have here, I've asked Sami Beidoun. Sami is the head of Beritech Fund 1. Sami and I have invested in about 15 different companies over the past close to 10 years to give his perspective of what are the key learnings that he has in terms of investing in companies from a valuation perspective, from a term sheet negotiation perspective. I've also asked the other side of the panel. I've asked Ziad, who has received money from Sami, and he is the owner of a company, what is his perspective in terms of the positives and the challenges that he faced in terms of valuation of his company and in terms of term sheet negotiation of it. I've also asked independents that you will have, so, and I ask, in this case, we will, that will block it go. So I've asked Raja also to come. Raja is an advisor. So Raja would advise different companies, and he will come, and his perspective, what are also the key learnings that you have. And I ask a couple of other people. So you hear it not only from Constantin, you'll hear it from the investor perspective, you'll hear it from the head of company's perspective, you'll hear it from advisors' perspective, what are the things that are working and what are the things that are not working in terms of all the key learnings that we have, positives or negatives that we have. Okay, so this is, now at the end of the day, I could go and I could carry this and I could speak for hours and hours. It's a subject that is very close to my heart. What's important for me is what are the questions that are in your head? And in some ways, so what are the questions where you need to have answers to in terms of either valuation, in terms of term sheet, in terms of shareholder agreement, or also in terms of investment management? Because once you receive the money, how are you going to spend the money? So what we have, I take the example of Ziad. He doesn't like me to pick him as an example, but in the case, because we've been meeting for the past hour with a potential investor also in the room. So suppose that he gets $1 million or he gets $2 million. How is this money going to be used? So Ziad might have different initiatives. He wants to open the US market. He wants to strengthen his distribution network in the Middle East. He wants to invest in new products. So Ziad will have different options to different options where he can invest in. Now, what's important, at the end, he will succeed or he will fail depending on the quality of the investment that he's going to make. He will get the money. We agreed on the valuation. He has the money. How is he going to spend the money? So, and most of you are going to be faced with this situation. When you have this pool, how are you going to spend it? And there's going to be a lot of initiatives in front of you. And one of the key decisions in terms of if this company is creating, it depends on the quality of the investment that you will be making with your board. Okay, so we will spend also time on and looking at these different opportunities. How do we assess, or how do we help Ziad or others or Roger to be able to say, look, this is for me out of these 5, this is the most important one. So we'll cover this, and I call it investment management. Okay, so this is what I will try to cover. Now, what are the questions in your mind that you need answers to beside those? So either in the topic of allocating resources, the topic of valuing a company, the topic of negotiating a shareholder agreement. So what will be the question that comes to your mind that you would like to have answers to? So what we have here, these will be the what I will call the questions. Okay, so with questions. So here is more, I'm going to put it more general. Okay, so I will say valuation. So valuation methodologies. So what we want to do is what are the different valuations methodologies? So what are the different valuation methodologies? So you have examples. So one could be market base. You could have another one that you could have is discount cash flow. So we call it DCF, which for those of you who is not, it's discount cash flow, and I will show you discount cash flow. You have other means, which is asset-based valuation, and I'll explain to you what are. So you have different valuation methodologies. I'll explain to you briefly. We're not going to go into a lot of details, and then I will share with you the pluses and the minuses for each valuation methodology. This is important. Yes? No, you have actually more than this. You have different. Now the gentleman next to you have a special valuation. I won't mention it, but it's called the Roma valuation. But it's so Sami will say Roma. So how do you value a company? But ladies are present, so I will not share it. Can I share it, Sami, or I don't share it? I don't share it. Okay, very good. So this is. So this is, no, but in the Roma, I'll let you decide what it is going to be. But what he says is there is so many valuation. At the end of the day, it's more of an art than a science, you know. So it is, That's a
very dangerous thing to say.
It is a very, but it's
all about the valuation.
Yes. Anyway, so valuation methodology is a very important point. We will cover it. This is a very key. What else do you need to have answers to? Yes.
The negatives and the positives of making more than one investor in the same fund, in the same seed.
Okay, so what you have here, I'm going to also put it larger and correct me. So what I go, and I think it's a very important one, is how do you go about the selection? What are the selection criteria for investors? So what do you go about deciding one or two? I use Ziad again because it's been recent. Ziad has 1, 2. You have Beritech. You have another fund behind it. On it, you have 2 investors beside yourself. So it's 3. So he's considering maybe potentially 2 more. So what we do is we look at the process. What's important is what are the criteria that you decide. So we will ask him what will be the criteria in his mind in terms of investor. What is he looking at? Why this investor versus another investor, which is critical. Whether it's 1 or 2 or 3, we will also discuss this. There are pluses and minuses behind. So what we have, selection criteria for investors, and then what we'll do is the number of investors. Because in, so what are the values of having more than one investor, and what are the values of maybe, or the disadvantage of having several investors?
And also, what kind of investors at different rounds? Yeah, maybe at
Okay, so selection criteria. So the other thing that we have is basically what you go is the type or the profile. We go through the profile of investors. So you will see that you need different profile investors based on maturity. I will call it maturity of the company. This is a critical one. What you will see, and you will see that depending on the company's phase, whether it's a startup, whether this company is in a growth phase, whether this company is in a mature phase, you will need to have different types of investors. So the profile of investors will vary over a period of time. So it's a very important question. Yes, Ziad.
The number of the people on the board in regards to starting investment rounds. And let's say if we're going for a Series A, how many do we need to have on the board now to leave room for the investors who will come later in Series A and B and C?
Okay, so here is the issue is more about dilution.
I'm talking about board seats, numbers.
Okay, so we have, I'll put, okay, so we will put, so here is basically the number of board seats, the number of board seats in relation versus the growth of the company, the growth phases of the company. So we will have this. So how do we go about evolving your board as the company is growing and moving from one round of funding to another round of funding? Because each round of funding will have potentially new investors coming in and new board members coming in. So what we need is we need to look at number of board seats of growth, and I would relate to it and dilution of main shareholder, Yes.
Can you also talk about preferential shares?
Preferential shares. Okay. So what you have, we could discuss. So this will be. So I'll put it in the contest. I will look at term sheets, components, the term sheet components, and in this term sheet, what will be, and one of it is preferred shares. So what we have here is we could have preferred shares, but you could have others behind it. Let me make sure I understand the question. So your question is, if a company agree on a valuation, this valuation could be linked to specific milestone. Is this what you're referring to? And if these milestones are not met, what is the impact on valuation? Is this what you're asking? Okay. So what we do is we have valuation milestones. We will put milestones on future deliverables. And we will carry this because a lot of the discussions, if you go and if you have, Zaki. Okay, so what you do is you have, so we'll discuss this. This is an important point. So what you have here is you have the dynamics between investors and founder. I think this is a very important topic, and this will be reflected in your selection criteria. So for instance, I use Ziad because he's going to talk, but in the case of Ziad is here, or any founders of a company is here in order to ensure that he has sustainability over a long period of time. So in some ways, when we look some of the companies that I work with, it's not only a matter of 5 years or 10 years, it's how do we prepare this company to move from one generation to another generation, to a second generation or third generation. So there is a long-term horizon. When Sami and I go and invest in Ziad's company, we know that over 6 years or 7 years, we need to go out. So our interest is to make sure that the valuation of the company is as high as possible in 7 years. And we might want to take decisions that are not necessarily aligned with Ziad's decision, which might have a much longer. So how do you reconcile the two, and what are the ways to be able to avoid to have conflicts between? It's an interesting, because investors would have different expectation. In our case, we know that we're exiting. We are part of a fund. The fund is close-end. We need to make sure that we return our money in 7 years, 8 years on it, and we want to return it as a high valuation. So it's a very important point, and we'll go through it. Yes?
You talked about the mechanisms of the exits, how
how they happen actually.
Okay, this is a good one. So what we have is the exit opportunities. Okay, exit is quite important and a lot. مرحبا. تفضل. Okay, so we have, you could, I think you have enough, is there enough seats? If not, you have to grab. عندك حداك في محل. Okay, so we have, زكية ما عندك, okay, لأنه شفتك واقف. بدك تشوفني أحسن؟ لا ما في محل هون إذا بدك هيك بتشوفيني direct. No, it's نعم زكية. But you know, you're safe. So this is, exit is quite important. You know, when Rula gets into a marriage, you know, the first clause that we decide in the marriage is what is the divorce. So when you get into a marriage, you need to know what is the potential. I'm taking Rula is a good friend. So what we have is the divorce clause is quite important. Is you need to specify what is your what is the exit strategy? So I'm getting a nut head in saying, Constantin, this is not a good example. So don't use it. You know, it's the wrong route. You're getting into a minefield there. So don't get close. What's important in terms of exit strategy? Exit is very important. You need to know what are the, who asked the question about exit? Okay, so it's very important to understand what are the types of exit, what is the timing of the exit in order to avoid misunderstanding in the, so because we will be exiting. Any investor at one point in time needs to exit. So we need to know upfront so as not to cause any unnecessary tension and pressure. So exit opportunities that we have. Any other points? No other points? Okay, so what if I have to add the list? I actually wrote a few points here, and I want to make sure that you have captured. Okay, so what we have, okay, how do I tell how much money do we need to raise? Okay, another point that you have is when you're raising capital, you need to understand how much money do you want to raise. How do you go about assessing the amount of money that you need? So here is about identifying funding needs. Funding needs. A number of you comes and say, Constantin, I need $500,000, or I need 300,000, or I need $1 million. And the question is why? Why do you need, how do you go about deciding what is the amount that you need? So identifying the funding needs is quite important, and I'll show you ways where we could do it. The other, related to this question, identifying funding needs, is then identifying the use of funds. How are you going to use these funds? It's quite important. How much money do you need, and how are you going to allocate these funds? It is very important if you want to be perceived as a serious company. You need to have questions to this. Why $500,000 or why $1 million, and how am I going to use this $1 million in order to be able to make sure that I maximize the value of the company? I'm going to pass on afterwards Ziad. Ziad, you might also be. Ziad represents. He founded his company. He presented last time here on a different perspective on governance. I'll ask him to come and share with us the finding that he had in terms of valuing his companies, in terms of raising the funds, in terms of negotiating with investors, and in terms of how does he maintain a positive relationship and ensure that each of these investors are extracting value behind. Okay, so we will have this, and then you will have Sami. That will be good to have actually both of them. So you'll have because both are part of the same board, and I tend to be the arbitrator between the two. So this is at 2 o'clock. It is 2 o'clock. What time is it now? 2:25. Okay, 2:25. So what we do is we could start. Actually, we could I'm trying to think loud. Okay, I'm going to start with some of the topics. Then what we do in about 10 minutes, we'll bring both gentlemen here, and then we're going to have discussions with both of them. So this gives you a good perspective to have it, because they have been working together now for the past, how many years? 4 years or 5 years? 5 years. And both of them are still smiling. Sami, are you still smiling? It's still smiling. So this is good. So this will be a good perspective here. What I'm going to do is I'm going to start with this one, which is quite important. How do you go about selecting the right investor for your company? So what in your mind will be the criteria that you'll decide in deciding whether this investor is علي تفضل جيب كرسي معك جيب كرسيين and probably somebody else will come. So it's Okay, so what in your mind will be the criteria that you will have, screening criteria to decide which investors you want, what investors you want. So this is what I call selection criteria for investors. So what will be the criteria that you will use? What do you think are criteria? Yes? Okay, this is very important. So one of the things is you need to decide the amount of added value. So this person needs to make sure that he's going to add value. And this applies not only to investments. When you decide to marry someone, ideally you would like to have a person that is here to help you develop your potential as much as you can. It's exactly the same principle that you have in terms of, so you want somebody who can help you because you have a potential. How do you help you grow to this potential and develop? Or in other words, to fly, to be able to go there. And so one is the amount of value added. What is the other criteria? History is important. So what we have is you want to check that the person has a proven track record. Proven track record. The proven track record is if you have an investor coming in, you want to make sure that the investment has done it before. So this investor have gone through, worked with other companies, not only funded these companies, helped these companies grow and exited from these companies. And today in Lebanon, very few people can claim what Sami is claiming, that he has invested, he has helped companies develop, and he has exited from this. Very few venture funds today in Lebanon can make this claim. So the proven track record of funding, so you need of funding companies, funding and exiting these companies typically with a premium. So this person knows what it is to take. So the track record is quite important. What else would you look at? Yes?
Is your industry something they're interested in?
Okay, so this is important. Is the industry, you have a certain industry exposure. So industry exposure that you have. Why? Because in this industry exposure, you basically want to have network. You want this person needs to be able to open doors. Is he here? Can he help me open doors? And so this is quite important to have this industry exposure. So we have the amount of added value, and this added value could be different ways. This is one of the added value. The proven track record of funding and exiting from companies is important. What else?
Can you work with him?
Who said this? Okay, this is fundamental. So it is. So what I call is alignment in values. So you have alignment. Lina said alignment. Okay, so you have alignment in values. Alignment in values. I'm going to have the other one separate. Alignment in values is important. Why? Because it's a marriage. It is a marriage. You like it or you don't like it. It's because you have to sign it, you have agreement, and this is a marriage that could last 5 years, that could last 10 years, that could last longer. So if you do not align in terms of the values of the person, you are bound to have a lot of problems in implementing it. So the alignment is values is quite important. And then what you have here that Lina has added is the alignment in terms of the strategic direction. The strategic direction, the vision, you could say, why are we here? To make sure that you share this strategic direction. You share this vision. Marie-Michel.
Where do you place honesty?
Okay. Yes, this is important. Under the values, one of the key values, so I ask a number of you, you will see that integrity is quite critical. This is non-negotiable, non-negotiable. For some of you, transparency could be another value. So this is transparency. Give me ideas of other values. Integrity, transparency, what other values? What are values that are important for you as an investor or as a...
Caring about social impact.
Okay, so you could have social impact could be another one. So social impact. What is the... so you have another one that comes in here is accountability. Accountability. So this is something that is quite, are you accountable? You're telling me something, are you delivering it? Because if you speak, and there is no delivery, I lose track. Accountability, what other examples of values? Okay, you could have patience. You have patience, you have perseverance, you could have patience, you could have here, you could in terms of, I'm sorry? I mean, you would have a number. So these are, you need to decide what these values are. Okay, so the alignment in values is very important. في حدا؟ Okay, hi. So alignment in values is important. The alignment in the strategic direction is also very important. You know, I'm using the case, Muhammad Ali has been introduced to us for an investor here, so we have, and with Ziad, they've spent several meetings. These meetings lasted for a number of hours. At the end of the day, what was important is these two elements. What they were trying to do, can we work with each other? Do we have similar values that we have together? So can we see this? And are we aligned in terms of what are the future direction, future growth opportunities that we have in this organization? Is this something that because if we're not aligned here, we might be very well aligned here, but if we're not aligned here, we have a problem. So the balancing act between the two is quite important, is to be able to, at the same time, understand the values, align it, and at the same time, understand how we're going to do this. Now, in terms of other values, we have accountability, you have respect. Respect is I mean, I have a number of friends where they say the respect is quite important, the quality, the teamwork that you have. So these are numbers. So this is very important. This is also important. If the person doesn't have an industry, it could be industry exposure, or what could it be? What else could it be? What would be other criteria? Yes?
The knowledge of the industry, to understand the...
Yes, we have this. So industry exposure, industry knowledge. I fully agree with you. So the knowledge of the industry, the exposure that we have is quite critical. Okay, so what you have, you have industry exposure. What you have is you could have, I'm going to put it more general. I'm going to put it, each one of you, if I ask Ziad, what is his pain point today? He will say that I need to make sure that my distribution network in the Middle East is working properly. So what we have, so what I'm going to say is I'm going to say functional, it's not industry, it's functional expertise. So in his way, what he's looking is I want to have an investor who could help me make sure that I have the right distributors, help me find the right distributor in Saudi Arabia, help me find the right distributor in Turkey or in Egypt, and help me make sure that I could develop. So the functional expertise could be in sales, the functional expertise could be in marketing, I'm going to build a brand, the functional expertise could be in operation. So what you do is you have, in each one of them, you have pain points. So what are these pain points? And is this person being able to help in terms of functional expertise? What else? Time? What do you mean? Okay, this is important. So selection of the investors. So what you have amount is the availability. So availability. Because at the end of the day, if I cannot see him, every time I call him, for instance, when Ziad he had the first interaction, and he said, Constantin, ما فيني أشتغل معه. كل ما بتلفن له بيقول لي مشغول وعندي شو اسمه. So if he's not available, then the owner would say there is no value added. So availability in terms of time that you have, in terms of the presence that you have, it could be a joint meeting that you have. What else? Yes.
Complementarity and synergy.
Okay. So what do you mean by complementarity?
That means it's adding perspective to the applications, finding new markets.
Okay, so this is, for me, it's part of the functional expertise. I agree with you. So sales, marketing, it could be business development. A lot of it is on business development. This is quite important that you have. And the other one you mentioned is what?
Synergy.
So what do you define by synergy?
Synergy, having additional breadth to the product.
Okay, so this is important. So this is industry exposure, network coverage. Here is synergies. Synergies. So can he bring things that I don't have? You know. So is he adding in terms of? So this is important. You've forgot a couple of important ones. Yes.
Actually, I have a question about that.
Yes.
I'm a bit confused. Should we expect from the venture capital firm to help us functionally and certain things, or just to give us, to agree on terms and give us the money?
Okay, it's a very good point. So, and this point is related to another subject. You see, at the end of the day, you're the owner. So you need to decide. Ideally, you need to have both. I want to have the money, and I want at the same time to have value added. And this value added could have different ways and different shape. If you only have money, in some ways it is less interesting. But in depending, if you're a startup and you say, look, Constantin, I take any money that I need the money now, because if not, I have to close shops. Even if this person has no expertise, he trusts me, he's willing to put money in my company, I go with him. So this could be, so if you ask me, I would say ideally if you could have the both, it's important. But your first point in terms of the money is here, brings a point, because you could have an investor coming in, looking at Ziad's company, saying Ziad company is maybe worth $10 million. Somebody else comes and say, no, I believe Ziad company has a huge potential. It's worth $20 million. So Ziad will probably say, look, the second one is valuing my company much higher. So in this case, what we have is you need to look at valuation. So valuation range. So each investors will come, they will do their due diligence, and they will come up and give you a valuation range. You, as a person receiving, you prefer to work with a person that is more generous in terms of the valuation. The higher he value your company, the less diluted you're going to be. So if I take the example of, if I take the example of Nada, let's say she has her art gallery. In this case, we value this company at about $5 million. I'm willing to put $1 million in it. I will get 20%. If somebody else comes and say, no, Nada, your art gallery with all the potential that you have, and we know that it's going to be worth a lot, I'm valuing you at $10 million. The $1 million that I come in has a valuation, has a percent. So what we do is, in this case, the valuation range is important because the higher is the value, I use the example of Nada, the less she will be diluted. So instead of being diluted by giving 20%, she will be diluted at 10%, so she still keeps a big chunk of it.